Up until now, we've worked on skills that will help firms to understand things that have already happened to them in the past. This section focuses on how firms can plan for the future. I don't know whether you have a budget for your personal finances, but I can tell you that being able to budget, being able to predict the future and what you or a firm will need in order to make the future a good place to be, these are extremely important skills. If you are looking for an interesting career path and you happen to like budgeting, you will always be able to find a good job. Most people don't like budgeting, most people aren't good at it, and because of that, firms are always happy to find someone who has good budgeting skills. Now, why do we care? In order for a firm to do good budgeting, it needs to know what its strengths are and how it can gain competitive edge over other firms in its industry. So the budget is a plan for the future. It tells the firm what it needs and how many dollars it needs in order to do all of the things that it needs to do in the coming period, and also how to take steps to reach its long-term goals. So, what are these goals? Well, every firm has broad goals. Our firm wants to grow in our industry. Our firm wants to specialize within our industry. Our firm wants to become the low-cost provider in our industry, or maybe our firm wants to become the specialized provider or the high-quality provider. It's very important for a firm to be aware of what it's trying to achieve in the long run so that it can make smart decisions in the short run. The firm's long-term strategic plan is what it is trying to achieve over the next 5 or 10 years and how it expects to get there. The master budget is the next step in reaching those strategic goals. There are a number of philosophies for how to budget. Probably the most common is top-down budgeting. In a top-down firm, the boss decides how much resources to allocate for each division or each product or each activity, and then it is up to the people within that organizational unit to make it work. There are a few problems with this strategy. Number one, the boss doesn't always know what the individual firm organizational units need. Number two, people don't like being told what to do. Therefore, when the boss says, here's how much resources you have for the coming period, people's first reaction tends to be, that's not enough. And furthermore, when it turns out that that's not enough, people feel that it is not their fault. A better way to budget is bottom-up or participative budgeting. In that case, rather than telling people what they get, the boss asks, what do you need to achieve your goals for the coming period? this is a much better philosophy in terms of getting people to support the budget, because people feel that their opinion, their experience is respected, and they are more likely to know what they need than some top manager who does not work with them on a daily basis. However, you have to understand people's psychology. The firm has particular goals that they are trying to achieve, but individuals have goals too. And one individual goal is probably, I don't want my boss to be mad at me if I don't reach my budgeting goals. And I certainly don't want to fall short and get in trouble. Because of that, there is a problem with goal congruence. Goal congruence means two different groups are working for the same thing. In budgeting, we may have a situation in which we actually have goal incongruence. What the firm wants, I'd like to use resources to help achieve our long-term goals, is not the same as what individuals want. I'd like to make sure that I have enough resources so I don't get in trouble. Therefore, there's a significant incentive if you ask people, what do you think you can do and how much do you need to do it? Individuals are likely to game the system. That is, make reported budgeting choices that make their life a little bit easier. So, for example, if I'm in the sales department and I think I can sell 1,000 units in the coming period, I might tell my boss that I think I can sell 900. That way, I've created some budgetary slack. I've made my life easier. If I only sell 900, nobody will be mad at me. And if I actually sell 1,000, I look like a big hero. Unfortunately, this is a problem in terms of making sure that every department has the resources that they need. If the firm believes the sales department and plans for 900 units, and it turns out that the firm could have sold 1,000 units, they may not have enough resources to achieve that goal. Similarly, if I'm in the purchasing department and my boss asks me, well, how much money do you think you need for raw materials? I may tell the boss $20,000 when I suspect it's probably $15,000. That way, I might figure that, well, I have $5,000 of slack. If it turns out that things cost a little bit more than I expected, nobody will be mad at me. On the other hand, if I get the $20,000 that I requested, that means there's $5,000 that are tied up in my department and not available for some other use. Part of good budgeting is creating good communication between supervisors and subordinates and between one department and another, so that everybody makes decisions that are in the best interest of the firm. Another issue in budgeting is, where do we start? Incremental budgeting means that we start with last year's budget, which we then adjust for prices that we think might have gone up, or the fact that we think we're going to be a little busier or a little less busy than last year. Most people like incremental budgeting because it's fairly easy. We already have a budget basis. We just need to think about things that could turn out different. The problem with incremental budgeting is that it fails to get rid of that budgetary slack that builds up period after period because people don't always give budgeting numbers accurately, or at least honestly. An alternative to incremental budgeting is zero-based budgeting. In this methodology, firms don't start with last year's budget. They start with a blank sheet of paper, and then every item that goes into the budget must be justified. Most employees do not enjoy zero-based budgeting. It tends to make people feel that they're being attacked, and it's a lot more work. However, it's very good at getting rid of budgetary slack. What some firms do to combine the benefits of both of these methodologies is to use incremental budgeting for several years and then do a year of zero-based budgeting to clean out all the slack and start the process over again. This diagram is a master budget, and you can see that the master budget is not one thing. It's actually comprised of several subsidiary budgets that have very specific relationships to each other. The heart of the master budget is right here in the sales budget, because that is going to determine all the other decisions that we make. So, what do we need to know? Once we have a sales budget, we need to be able to produce the units that we would like to sell. If our firm uses a just-in-time inventory system, then the production budget is going to look exactly like the sales budget, because a just-in-time firm only makes the units that it believes it can sell, and it only makes them when those units are already sold, when they already have a customer for the units. Most firms don't follow just in time. Most firms instead have an inventory policy. That is, the future is uncertain. We certainly don't want to disappoint a customer. So we not only want to plan for the units that we think we can actually sell, we want to plan for some extra units in case there's a problem with our production system, or in case there's a sudden increase in demand. We want to make sure that we won't lose any sales. And I will show you how to prepare a production budget based on a sales budget. In addition, in order to produce these units, we need our three factors of production: materials, labor, and overhead. And we need a budget for each of these, both to plan how much of these things we need, and also to plan how many dollars we need in order to get these resources. We also need a selling and administrative budget to support our ability to sell the units that we think we can sell and to run the firm. In addition, the sales budget affects our capital budget. A capital budget would involve transactions in long-term assets, buying or selling property, plant, and equipment, or investing in the stocks and bonds of other firms. So based on the sales budget, we'd like to make sure that we have enough plants, machinery, equipment, vehicles, computers, whatever it is that we need so that we can achieve our sales goals. Also involved in the capital budget is our firm's long-term strategic goals. That is, if our firm is planning to expand, planning to diversify its product line, planning to refocus on its core competencies, all of these choices will be reflected in the capital budget. Now, all of these things take cash, so we can use the sales budget to estimate how much cash inflows we're going to have from our customers. We can also use our materials, labor, and overhead budgets to estimate how much cash we need to acquire these resources. Furthermore, selling and administrative activities use up resources, and we can capture those in the cash budget. So all of these budgets on the left-hand side of the diagram are what's called operating budgets. That is, they focus on what we need and what we're going to do. That's the input side. Over here, the financial budgets, including a budgeted income statement, budgeted balance sheet, budgeted statement of cash flows, these are outcome budgets. That is, they are the result of what we do. Now, we need to think, if everything comes out exactly the way that we have planned, will this period help our firm to get a step closer to its long-term strategic goals? If the answer is yes, then we're done budgeting. Now we have to hope that the future works out exactly the way that we've predicted. If the answer is no, then we need to go back into the budgets and determine what we can change that will help the future to be more like what we want it to be. Once we've done that, we can use the budget for control. In this context, control means, number one, setting benchmarks for people. This is what we now expect you to do. And then number two, giving people their own feedback on whether they achieved those benchmarks, and if not, investigating why. So, since the sales budget is the heart of all budgeting, let's start there. The first thing that we need to do is get our sales people to give us a prediction. How many units do you think you can sell in the coming period? Once we have our predicted sales, we simply take the number of units that we expect to sell and multiply it by the selling price per unit to get our predicted sales revenue. The question is how to get that prediction. One way is to ask our sales staff, because they know our customers, they've gotten feedback from customers, they know the market, they know the trends. In addition, they need incentives to motivate specific behavior. So asking the sales staff is a good idea, but it may not be sufficient because they do have incentives to game the system, to try to create some slack. Another way to get predictions is to ask market researchers. They're independent. They get paid for having specialized knowledge. We can also use that as a check on our sales staff predictions. Finally, market researchers often have more information about trends and changes within the market. A third way to get our sales predictions is to use what's called the Delphi technique, in which individuals submit their own estimates anonymously, and then the group as a whole looks at all the estimates and tries to come up with a consensus number. The advantage of this technique is that it reduces the bias that may occur with individual forecasts. Of course, the problem is it puts a tremendous amount of pressure on people. People don't like to be wrong, don't like to think that other people disagree with them. Another way to come up with a sales prediction is to use mathematics. You can use very simple mathematics, say in an Excel spreadsheet. You can do trend analysis by graphing past sales data and then looking for an underlying trend. For example, with the time series model. An alternative approach is to use slightly more sophisticated econometric techniques such as regression analysis, in which the regression program gives you the best fit line for a series of points. Either way, the choice of how many units do we think we're going to sell is a managerial choice. As accountants, we need to assume that people have made their sales predictions honestly and as accurately as it's possible to predict the future, and we need to be able to use that information to plan what the firm needs and what the firm expects in the coming period. So which is the best method? It really depends. Each firm has its own personality, each firm has its own agenda, and of course, you would never want to spend more trying to answer a question than the value of that information. So let's assume that we've gotten some data for Acme widgets for the second quarter of the coming year. We know how much the firm expects it can sell in each of the next 4 months, and we know that the budgeted selling price is $40 per unit. So what can we do with this information? The first thing we need to do is make a sales budget. So in April, we predicted we could sell 10,000 units. If we sell those units for a budgeted price of $40 per unit, that's $400,000. We can do the same thing in May with our predicted sales of 12,000 units, and we can do the same thing in June with our predicted 15,000 units. This budget is very useful. Now we know how much sales revenue the firm expects to generate in each period. Next, we need to make our production budget. In order to do that, we need to know Acme Widgets' inventory policy. Well, we're told that the firm expects to begin the second quarter of the year with 6,000 units already in its finished goods inventory. Those units are planned to be there. And the firm wants to end each month with 60% of the next month's expected sales in finished goods. That represents their just-in-case inventory, just in case a machine breaks down, just in case we can't get a delivery of raw materials, just in case we can sell more units than we budgeted. So this represents the firm's inventory policy. Now, to make a production budget, we need a couple of handy formulas. The first formula is the number of units that we expect to sell plus the desired inventory ending balance, that is, the extra units that we want to have left over at the end of the period, equals the number of units that we need. If this was our first period of operation, we would have to make all of those units. But it's not. This firm has been operating for a while. Therefore, the number of units that we need minus our estimated inventory beginning balance, that is, the number of units that we expect already to have on hand at the beginning of the period, equals the number of units that we need to produce. So each of these formulas is really a little story in a very condensed vocabulary. Let's put this story into action and make a production budget. First thing that I would do is jot down the number of units that I expect to sell in the next 3 months. And I got that information from the sales budget. So in April, I expect to sell 10,000 units, but I want to have some additional units left over at the end of April going into May. So in May, I expect to sell 12,000 units. My inventory policy is I would like to have 60% of that amount already in inventory at the end of April. So 60% of 12,000 units is 7,200 extra units. Now I can say that in April I need 10,000 units to sell and 7,200 units that I want to have sitting around in finished goods so that they are available on May 1st. And I can add that up. But I don't have to make all of those units because I am expecting to start April with 6,000 units already in finished goods. Therefore, in April, I need to produce 11,200 units. So what happens in May? Well, in May, I expect to sell 12,000 units, but I also need 60% of June's expected production that I would like to have available at the end of May going into June 1st. That's 9,000 units. So during May, I predict that I'm going to need 12,000 units to sell and 9,000 extra units. Altogether, that's 21,000 units. But again, I don't have to make them all because I expect to end April with 7,200 units. Therefore, in May, I only need to manufacture 13,800 units. What about June? Well, I know I want to sell 15,000 units, but I would like to have 60% of July's expected sales left over in finished goods at the end of June. Well, if you look back at the given information, we were told that the firm expects to sell 18,000 units in July. Therefore, it needs to have 60% of that amount, or 10,800 units, left over at the end of June. Altogether, that means the firm needs to have 25,800 units, 15,000 to sell, and the rest to go into the next month. But we don't have to make all of those units because we're expecting to have 9,000 units left over at the end of May. Net, we need to produce 16,800 units in June. So what this budget is telling us is the number of units that we need to manufacture in each of these months in order to be able to sell all of the units that we think we can sell and have what we consider to be an appropriate amount of additional inventory left over at the end of each month. And these are the numbers that will need to be carried over into the materials budget, the labor budget, and the overhead budget, because without our three factors of production, we can't make these units. So, here's a practice problem. Jim is preparing the production budget for his company, and he has estimated that he needs to make 21,000 units to meet the sales forecast of 18,000 units. His desired ending inventory is 4,000 units. How many units does Jim need to find in his beginning inventory? Well, let's take a look at the solution. We know that the number of units we expect to sell plus our desired ending inventory equals all of the units that we need. In this case, we expect to sell 18,000 and we want to have 4,000 units in our ending inventory. That's 22,000 units that are needed during the period. Our second formula is that the units that we need minus our estimated beginning balance equals the units that we need to produce. Jim has estimated that he's going to produce 21,000 units, and we know he needs 22,000 units. That means he must be expecting to find 1,000 units in his beginning finished goods inventory.